Obviously, we're facing a very challenging year this year. I mean, I don't know. I've been telling folks for the last 2 or 3 months, said, well, you're going to set a record for the price of your hogs that you sell this year, and you're going to set a record for total revenues, and you're probably not going to have any of it to show for at the end of the year. That's a very real possibility. Now, we've been through years when it's been worse, okay, haven't we? So, break even is not the worst thing that can happen to you. It's just kind of disappointing when you're looking at these kind of prices. Key factors, obviously, grains and cost of production are going to be number one. There's some policy decisions still being made that are going to impact your operation. The ethanol biofuel situation still, we've punted that down the road for a year to make another decision. The GIPSA rule is still pending. Mandatory price reporting for pork cuts got added in this year, and so we'll talk a little bit about that. Some impact of the 2010 elections. I was in Washington this week, and the House Ag Committee has 46 members on the House Ag Committee. 23 of them are new to the committee, and 16 of those are freshmen. Okay, brand new representatives, have never been in a committee meeting before. So this is going into writing a farm bill in 2011 or 12, probably 12, and probably get it finished in 13. But that's kind of the backdrop. Frank Lucas, of course, is the new chairman of the House Ag Committee. Frank and I went to college together at Oklahoma State, and I don't know him real well, but certainly a much more conservative kind of leader that's going to pay a lot more attention to the bottom line on costs. I think if you look at, he's still not going to be anti-commodity programs. I don't think that's any way, but you're going to see a little different philosophy. On the Senate side, that's really where the unknown lies. I mean, Ms. Lincoln got beat in her re-election bid in Arkansas, and Deb Stabenow from Michigan is there, and Michigan cares a lot more about fruits and vegetables than anything else, and we don't know exactly what's going to happen on that one. So, and the Senate really hasn't even got started constituting what's going to be the committee on that side. So, it's going to be an interesting time. By the way, the other key person, and we talked to Pete Thompson, who's a longtime staffer for the House Ag Committee yesterday, is the chairman of the Livestock and Poultry Subcommittee, and that is Congressman Rooney from Florida. He is the grandson of Dan Rooney, who's the managing partner of the Pittsburgh Steelers. That's the Rooney family that he's from. A big citrus district that he's from, but a very pragmatic. Pete was really impressed with him, and it's not easy to impress Pete Thompson after 30 years in Washington. He's had multiple doses of cynicism, and so I feel pretty good about that. Macroeconomic situation, and by the way, Rooney was really kind of zeroed in on costs and what that's doing to livestock producers. So I was encouraged by that. The macroeconomic situation, especially the U.S. dollar, is going to be important this year. It's been very supportive to us so far. One of the things, if you've been here the last 2 years, I've been saying the dollar's going down. Well, there's times it went down and there's times it went up. I mean, every time the dollar weakens, some other European country has some crisis and the dollar strengthens again. And so all the fundamentals are still there for a weaker dollar, but we've had several interventions and kind of outside forces that have caused it from happening. And of course, finally, any supply response of producers. We did make some money last year, and it looked like we might have some supply response, but it's kind of stopped dead in the water, and we'll talk about why that is. Okay, ethanol. It's finally becoming a big deal for meat and poultry consumers. It's taken 3 years plus to get there, but I said a long time ago, these costs have to go to the retail price. And if we look at retail prices, I'll show them to you here in a minute. They've certainly started up for hogs, for pork. I think you're going to see them for cattle and chicken as well. 210 ethanol plants, about 14 billion gallons worth of capacity out there. Notice that cellulosic is 16.9 million versus 14 billion. Okay? That's not much. 1% of the total is cellulosic right now. Still not economic. We're not finding much better ways of doing that. 346 million still under construction. Full output would use about 5 billion bushels of corn. Now, that's an interesting number because right now the USDA forecast for this crop year is 4.9 billion. Okay, so we're very close. We're getting closer and closer to that capacity level. Ethanol plants are in the black for now. They've gotten back into some decent margins in 09 and this year again. Not the kind of losses they had, but again, anytime they get a pretty good margin, they bid it away pretty quickly, either in producing more ethanol, driving the price down, or chasing corn and driving it up. One of the things that's really helping them right now is notice that this area, this buff-colored area, is getting smaller, and it's because natural gas is relatively cheap and has stayed that way for the last 3 years. And I was in Oklahoma this last fall, and they're punching enough holes in the ground to produce natural gas that I think natural gas is going to stay a real bargain, and that really helps ethanol producers. If we look at the renewable fuel standard, it's growing, but notice that there's kind of an inflection point here in the starch-based renewable biofuels. It's only growing by 600 million per year now. All right, it was growing at a much faster pace, and it will grow at that rate until it hits the maximum out here of 13.5 15. Pardon me, in 2015. So the additions of draws of corn away from the market and the additions of DDGs back into the market are at a much slower pace the next 3 years or 4 years than they have been in the past. Here's where USDA's forecast in the January WASDE report was. They increased ethanol usage from 4.8 billion to 4.9. They dropped feed usage down to 5.2, and I think that number might be a little high yet. Kind of level for exports so far this year, and of course, feed, seed, and residual, industrial and seed, other than ethanol, kind of rocks along at the same level. That's still primarily high fructose corn syrup, but it's not going to be long here until these two lines cross, and ethanol is the largest user. If we look at total corn production and we back out the amount used for ethanol, here is the production above ethanol usage, and you can see this year it's the lowest since back in 1990. That'd be the 1993 floods, I believe. So the lowest available outside of ethanol since that time. If we take feed and residual and add in net DDGs, and you have to add in net DDGs because we exported about 21 or 2% of all DDGs last year. We would export more than that this year unless China slaps a dumping margin on. So that could be something that forces DDG prices lower this spring. But that's just level. So the challenge on this situation is this gap is going to grow. Depending on where our crop is, whether we got corn available for feeding is a question. But I'd say the conclusion right now is that we're going to have kind of a level total supply of corn plus DDGs for some time here, until we see dramatic increases in yield. And we haven't seen that. I mean, still an uptrend on trend yield. Last year was a deviation below that, and we're going to get some of those. Of course, my fear is the same as it's been for 4 years. When does the next 1998 drought come? And we are now at the limit of the time period between those droughts, based on over 600 years of tree ring data put together by Elwyn Taylor, 23 years. Longest time period ever. So this would mark the 23rd year. So, we're living on borrowed time. We're going to get one of those droughts. It won't have the impact it had in 1988, 21% below trend yield. I don't think there's any way it'll do that. Our varieties are better. But we don't have that much slack at this point. And so that's still the fear that I kind of live with. And if we ever get one of those, that following summer is going to be a real tough situation from an animal welfare and a cost situation. Not just cost. It's going to be an animal welfare as well. Important policy decisions this winter. Obviously, the 15% blend allowance has been made for 2007 and later. This is an allowance, not a requirement. Okay, so it allows them to blend that. And what we're seeing is hardly anybody's blending to that. And the reason is you've got a lot of logistical problems here. You've got to have another tank. You've got to have another pump. There's some liability issues because it still hadn't been approved for these older cars. What somebody comes in and puts it in an older car and it screws them up and da-da-da-da-da. So this isn't at play, in my opinion, in the market, but it's there. It's an allowance that would allow that usage to grow if the market said it would. And by the way, the whole ethanol situation is far more market-driven now than it's ever been. I mean, if you look right now, somebody said a couple weeks ago, well, this thing's so tight, we need them to set aside the renewable fuel standard. And I said, well, that's fine and dandy, but it won't matter this year because we're producing more ethanol than what the standard says. So that's being driven by oil prices, by a number of things. Now, if you drop the blender's tax credit and import tariff, that would have some impact on price, but it probably wouldn't have much impact on corn usage this year. Next fall's decision, last fall's decision is punted down 1 year. So this puts it next fall. We're going to talk about this. And the Iowa caucuses for the 2012 presidential elections are February 2nd of 2012. Okay? That is just over a year from now. So the parade through Iowa will start any time now, and we'll have nothing but candidates anywhere. You know, you can't swing a dead cat without hitting a candidate when the caucus season starts. Even if you did want to swing a dead cat, I don't know why you'd want to do that, but you know, we're going to have a whole bunch of them, and this is going to get thrown in. And it goes back to the argument I've made for a long time. If Iowa wasn't first in choosing a president, we wouldn't be in this pickle, because that has really driven ethanol. I think it's really driven ethanol policy, and it's going to play into it this time. There's some restructuring talk about changing the blender's tax credit and taking some of that money and putting it into infrastructure or distribution systems. And then there's always this threat of a trade action by Brazil. I mean, they're importing ethanol from us now. And if they think that that's dumping and that we're subsidizing those imports, they would probably file a trade case. And I wouldn't be surprised to see that happen. Now, they're doing it on their own free will because they can sell sugar for so much money right at the moment. But still, that still doesn't keep a country from filing a dumping case. I wouldn't be surprised. And then there's Al Gore. You remember Al Gore, the guy who invented the internet and discovered global warming, and learned how to grow a beard. It's not good policy to have these massive subsidies for first-generation ethanol. The energy conversion ratios are at best very small. I love this one. I had a certain fondness for farmers in Iowa because I was about to run for president. The percentage of corn being used for ethanol definitely has an impact on food prices. I mean, after all that's been said, and then he comes out and says that this fall. You just gotta love it, I'll tell you. So, anyway, I thought that the timing of that may have been the kiss of death for the renewal of the blender's tax credit and stuff, really. I mean, he said this in September, I believe, or August, as this discussion was going on in Washington, and yet it still didn't get it killed, didn't allow it to expire, and got it renewed for another year. I was kind of surprised after that comes out. Okay, let's talk about the situation. Well, here's the situation we're in. These are the January numbers from the crop report and WASDE. Of course, the important ones are this one, 152.8 on the yield. They started out with that's last year, back last summer with a 163 and change, I think, on a trend yield, and so 10 bushels an acre lower than where they started. 12.447, a disastrous crop size for us. It's just the third largest ever. 20 million bushels imported, total supply. Here's usage. That one stayed the same on non-ethanol, food, seed, and industrial. The increase in ethanol, the decrease in feed. They left exports the same. Carry out of 745 million bushels. Now, we used to have carryouts much smaller than that back in the 70s. I mean, 300 and 400 million. But that's when we had 7 and 8 billion bushel corn crops, too. If you look at the ratio of stocks to use, this is the second lowest number ever. 5.5%. Okay? 5% is somewhere around 3 weeks. 3 weeks of supply or so at the end of the year. Now, I wrote in my hog farm, in the CMA column a couple weeks ago that America will not run out of corn before the end of the crop year. That doesn't mean that some Americans won't have trouble finding corn in a reasonable distance from their farm. And there will be some spots that are going to be really, really tight come August. We saw this happen 2 years ago in the soybean business. Crushers were really scrambling to find beans for a few weeks, and a lot of it's going to depend on the timing of harvest and other things. So, and now I'm talking to the people that probably don't have to worry much about that. in southern Minnesota, northwest Iowa, eastern South Dakota, you're probably in a better spot. But you also have more ethanol plants than anybody else. I still wouldn't get into the late summer months without having physical corn to get to harvest. Okay? I don't care what your positions on the futures market are. You can't feed them paper. So have some corn on hand or DDGs. Just talking to a producer this morning, he's a little concerned about DDG supply, and you might ought to think about that. That's a hand-to-mouth kind of thing. All right? So let's think about that as well. Here's the relationship. Of course, second lowest stocks to use. By far the highest season average weighted price. Now, you say, well, wait a minute. We had almost $8 corn in the summer of 2008. Yes, we did. But very few people got to sell it at $8 because it was in the summer after harvest. This year we've had a much higher price during harvest, and so it drives this season weighted average price up because that's the monthly average weighted by marketings per month. Corn, well above what here's one of them that you can look back. I told you, I think we're going to trade corn in this new range. Well, we're well above that. And the question comes, is this the new range? I mean, have we bumped this up there? And I think one of the key to that is oil going to stay at $90 a barrel? Well, with an expanding world economy, oil could stay pretty expensive for a while. I don't see $140 oil, but I don't see $40 oil in here at all in the next year or two either. So a big issue. Here's the relationship on those. You can see where oil has come since late 2008. Here's the crash in 2008, and it really was kind of soft, but it's recovered well as the economy is starting to grow. You've got world economies outside of the developed countries that are growing at a clip of 5 to 7 to 8%. India, Brazil, China, large, important economies. And so they're going to drag oil prices, keep oil prices high, keep corn prices high, I think. On the soybean side, we had a good soybean crop, but strong demand. We've had excellent export demand. You've got some questions about the South American crop, and this one, obviously, we have that South American crop that'll come out in March and April and into May, and could help us out some on soybeans. So I wouldn't get too aggressive on soybeans at this time until we see what that South American crop is. But we're going to have a huge Donnybrook of a battle for acres this year. And we've been here before on a battle between corn and soybeans. But this year, you've got cotton and you've got wheat in that mix that are going to battle as well. And right now, wheat's in the losing position. But cotton is going to really fight pretty hard for acres in the southeast that could go to soybeans and then push more corn acres up into the corn belt. It's going to be interesting how it unfolds. Corn hog price, feed price index, about $100 a ton higher than a year ago. So, and that's going to stay that way. We got some breaks forecast by the futures as we get into late 2011, but still somewhere in that 230 to 220. The longest sustained period, I think, of these kind of feed prices we've ever had. I think that's almost certain. And if I put them into the model I have based on the Iowa State returns, here's where we are on cost of production. Clearly record high. The average for the year would be 82.70 on a carcass weight basis. Highest on record forecast at the present time. It takes some pretty big sell-offs to get this. Now, one of the policy issues that's hanging out there, and I'm not going to spend a lot of time, this is not a dead horse, but it's certainly been kicked a lot, is the GIPSA rule that's pending in Washington. To bring you up to speed, it was published in July. The comment period ended in November. There were 60,000 comments filed on this. About 16,000 of them came from pork producers or through pork producer channels. The USDA has said, during the whole process, we were getting word that they weren't going to change this rule very much. And then after the comments were filed, the Secretary's statement was a little more conciliatory than that and said, well, we see this as a beginning and we're going to take these and try to write a final rule. The word I'm getting is late summer, early fall, probably on a final rule. It's not going to be anything that's ramrodded very quickly through USDA and through GIPSA. They were charged by the 2008 Farm Bill to write rules on 5 5 topics, and there's the 5. This one is specific to poultry. The others would affect everyone, not just poultry, but almost all of them grow out of situations in the poultry business. I mean, that's really where the complaints were that drove this thing, and some concern by some folks at GIPSA that, they think that they're saving the pork industry from the fate of the poultry industry to some degree, and so that's part of it. But really, these were the 5 that Congress charged them to do, that kind of everybody agreed that was okay. Okay, but being good bureaucrats, when they started writing rules, they decided to write a lot of rules. And they have a number of things in here. One of them is a very restrictive competitive injury definition. First, we're not real sure what the term competitive injury means because it's not used in the case law and it's not used in the research. We had injury to competition, which we economists would say that that's the situation where market behavior in some way causes a price that's different from what a competitive market would have given us. If they're selling, it would be a higher price as in a monopolist or having market power on the selling side. If you're buying in animals or buying inputs of any sort, whether you're buying coal or whatever else, if you have market power and can force your purchase price lower, then you're a monopsonist or oligopsonist or market power on the buy side. And this says that any deviation from that is a violation of the Act. Now, the problem with that is that a lot of our research finds that in agriculture markets there are deviations from competitive norms. But we also find that there's usually some offsetting positives out of it. The perfect example is there's been a lot of work on fed cattle. And they find that packers generally have some market power and can push fed cattle prices lower. But because those packers have large, efficient plants, they can pay more for fed cattle, and usually that offsets the difference. And the courts look at those offsets. This definition doesn't allow that. It just says any damage, it's illegal. It's a violation. Likelihood of competitive injury definition is kind of odd. One of them is foreclosing competition through exclusive dealing. My guess is it would be a matter of weeks before somebody filed a lawsuit that says that a marketing contract is exclusive dealing and thus should be illegal. Okay? And it really is kind of exclusive dealing, at least on the volume of animals we're talking about. Requires written justification of any price or contract terms, and this, if you have production contracts, you are subject to the Packers and Stockyards Act. So this refers to your production contracts with your growers that deviate from standard prices or terms. So if you've got 3 production contracts out there and they're not all the same, you've got to provide a justification for why they're not the same. Now, the kicker on that is it doesn't say what is going to be viewed as acceptable justifications. So you may think you've got a decent justification, and 2 years hence in the lawsuit somewhere it might not be the case, or the GIPSA folks might not agree. Conduct can violate the Act without finding of harm competition. This is a big deal, and it really comes from 2 or 3 places. The number one reason this has happened is that over the last 80 years, they kept amending the Packers and Stockyards Act and throwing a bunch of crap in it that wasn't supposed to be there in the first place, like contract grower relationships. And so now, somebody files a lawsuit under the P&S and says, my contractor or my broiler producing company mistreated me under a contract growing. And the courts look at it and say, wait a minute, that may have harmed you, but it didn't harm competition, so it's not a violation of the Packers and Stockyards Act. And that's kind of infuriated all the folks that are supporting this rule. But 8th Circuit courts have said that this law is about competition, not competitors. And the Congress, in the 2008 Farm Bill, actually considered adding this clause in. And they said, no, this is about competition. We're not going to do that. And so now, these guys, they don't agree with that. And so they decided to just write a regulation that puts in what they think is right instead of what the courts and what Congress has said. So as a citizen, that kind of bothers me a little. And we're seeing more of that in Washington these days than we probably ever have. A sweeping definition of unfair and deceptive practices. Some things in there are okay, are good. Some are pretty bad. It bans packer purchases from other packers or affiliated companies and doesn't even go as far as to define what an affiliated company is. Now, some of you in this room are maybe involved with Triumph. I think you've got some real problems under here. It means that no other packer can buy your extra hogs or your cull sows or whatever directly if you're an affiliated company to a packer, and if you're an owner of Triumph, I don't see how you couldn't be an affiliated company. And the same is true for U.S. premium beef. That doesn't mean those animals can't be sold. It means you can't sell them directly, and they're going to have to move through some kind of a broker. Submission of all unique contracts within 10 days. So production contract, marketing contract, if it's unique, which it doesn't define what unique means actually, you've got to give that to packers and stockyards within 10 days of execution. They can post them on their website, and they said that they'll ask you for personal, confidential, and identifiable information, and they will block out personal and confidential and identifiable information, but it never says that your idea of that stuff and their idea of that stuff will be the same. So you don't know exactly what's going to be blocked out. Restrictions on contract lengths, you have to have them long enough to recoup 80% of investment, whether that be an original investment or an additional investment. There's no delineation there. It means that if you want to sign a 4-year contract, thinking that maybe you can negotiate a better contract when that one's up, which many growers have been able to do in history over the years, you can't do that if that's not long enough that you could recoup 80% of your investment. Many restrictions on terms if an investment is $25,000 or more, so a very low threshold relative for the pork industry. What's the impacts? Well, I think it's going to be homogenization. You're going to see far fewer premiums, no premiums other than carcass, or very few, because packers got to justify all of them. You're going to see very constant pricing during the day. We're going to put one price out for the day, and that's probably all we're going to do, because we don't want to have to go argue with somebody that we were justified or not in changing it during the day. I don't think, a lot of people say, well, our carcass merit programs are going to go out by the wayside. I don't think that's the case. Packers will have to justify their premiums on their carcass merit programs to the government. Whether that's good or not, I don't think it is. But the other thing is that while they may not be after these things, there's nothing in the rule that says they can't go after them either. So that's a problem to me. Higher costs and risk of using contracts, significant written documentation required. It opens the possibility for challenge after challenge, especially if you don't have to show that the behavior damaged the marketplace, only that it damaged me. It's a real kind of a goofy situation that puts a lot of people in. Big difficulties for those packers on that packers or owners of packing plants. This whole thing of legislation by regulation, like I say, really causes my blood to boil. Uncertainty and liability always equals costs. Variations will be ignored. I think that one of the impacts of this eventually is that it'll be more expensive to do business with production contracts, creating an incentive to own the buildings. And the chicken folks have said, if we have to live with this rule the way it's written right now, we'll just start owning our own production buildings and not do contracts with people and put our employees in charge. The second one is if it takes more expensive to do business with marketing contracts or you lose those benefits, the incentive is going to be there to own the animals. So I think this will create incentives for more vertical integration, not less. And it's certainly, right now though, it's an uncertainty factor that I think has limited the reaction of the whole livestock industry to some good times last year. And that is probably a good thing. This whole uncertainty about regulation is one of the reasons our economy hasn't kind of started cooking again, in my opinion, too. We've got a health care bill, we've got a financial regulation bill that are out there, and nobody knows exactly what the rules are that they're playing under, and so a lot of companies are sitting on their hands. We got companies with a lot of cash. They've made money, but they're not hiring anybody because they don't know what the rules of the game are going to be. Mandatory price reporting, reauthorization. The system is in place for another 5 years. No problems this time. Senator Grassley must not have been paying attention or something. I don't know what the deal was. No, I think he was. But there wasn't any kind of real controversy. They did add wholesale pork prices and volumes. The goal really was to broaden the base of the prices being reported because we've only, since 2005, we've only had, on a weekly basis, between 3 and 4% of all of the wholesale level production that we've had prices reported on those wholesale cuts. It's very thinly reported. It's pretty thinly traded. A lot of things are formula priced in this market. And so the industry kind of said, well, we probably need to start getting those prices. There's a negotiated rulemaking process which brings all the parties to the table to write the rule. It doesn't let USDA write the rule and then you try to fix that. It brings everybody in. After this GIPSA rule, that was one of the things we kind of insisted on. They have formed a committee. Its first meeting is the third week of February. They hope to have a rule by the end of the year, and then it'll take 4 to 6 months to get started. So sometime mid next year, I think we'll see mandatory price reporting on wholesale cuts. Now, you need to set your expectations reasonable here. There won't be anywhere near 100% of the cuts involved. And the reason is a lot of those cuts are internal transfers. Hormel doesn't sell a belly. Okay? That'd be my guess. I know a lot of companies don't. Because they make their own bacon. And so those internal transfers, there's never a price on them. And they won't be included in here. So it'll be, where I'm guessing somewhere around 40% of the volume, but last I checked 40 was greater than 4, so I think that's probably good. But that's one reason. The other one is that the products that are sold, many of them aren't negotiated. They're formula priced off something else. And so they wouldn't be in here either. So there's a lot of details that have got to be put in here. Now, there's some folks who have argued with me on this, but I think initially the USDA cutout value will decline when we go to mandatory price reporting. And the reason is that under a voluntary system, if I'm pricing a lot of hams off of a ham price, I have a great incentive to report the highest ham price that I sell them for. Okay? Now they're going to say, I've got to report all of my ham prices. And so I'm not going to just report the highest, but I'm going to report the lowest ones too, and the average is going to go down. And I think the cutout value will decline for a while after we start here. So the message is, if you're thinking about transferring hogs based on cutout values over the next 2 years, you want to make sure that you've got an out clause in your contract that says when they go to mandatory price reporting, this pricing mechanism will be reviewed and must be mutually agreed upon or something like that. Don't get locked into a cutout value thing for the next 5 years when the cutout value may change just because of the way we report the prices next summer. Okay? All right, meat and poultry demand. This is one that we were crying about early in the year, and it's gotten a whole lot better. This thing has really been good this fall. The indexes for the year are still down. This is chicken, pork, beef. I'm still very concerned about this trend, but look at where we were in November. Pork was, the November, just that month, was 14% higher than a year ago. January of last year was 11% lower. All right? So this thing has gotten progressively better all year from a demand standpoint. Chicken up 5, it was down about 7 on January. Beef up 2, it was down 9. Okay, so this thing has gotten a lot better as we've gone through. I think December is going to be kind of flat. We had, the pork price, retail pork price was down, but still, certainly we've seen a lot more strength in consumer demand as we've gone through the year. And part of it is that these retail prices are kind of finally catching up with where we've been on the wholesale level. We set 6 records on pork from May to October. We're down the last 2 months, but not, obviously still well above the record prior to that. We're within pennies of a record on choice beef. Same for all fresh beef. Chicken's within about a nickel of its record. Turkey set records before the normal seasonal break in turkey prices. And you're going to see beef, I think, break all of its records probably within the next 2 or 3 months. We've really dipped into this supply of fed cattle to a great degree, and these cutout values are going up. The restaurant index has become positive again for the first time really in 3 years. October was the best it's been in a long time. It backed off a little in November. So we've seen some real improvement on the food service side. And those all deal with domestic demand, okay? And then look at what November exports did. A huge jump from October, up about 7%. They were down about 3% in October. Year to date, we're up 2%. Not huge growth, but holding our own and staying on this 04 through 07 trend. The value of exports in November was the 4th largest ever. And so that's the one that really impacts your hog demand, because if they can generate value on exports, that can go back against hog prices. Very strong byproduct values, still somewhere around $40 to $50 million each month. we look on pork by market, Mexico is once again challenging Japan as our largest pork market. They are our largest variety meat market by a long ways. And so if you look at the volume of U.S. pork products shipped out, Mexico is the number one destination. China, Hong Kong has recovered and was the number 3 market in November. Canada, kind of always steady there at number 3 or 4. And some growth to Korea here late in the year. And long term, this is going to be a very, very, very important market with the passage of the Korea Free Trade Agreement. Dermot Hayes, I think, estimates that when that's fully implemented in 2015, $10 to $11 per hog just for shipments going to Korea. So some really good things going on there. Beef and chicken are going to be quite positive for us. Now, at one time, a few weeks ago, I wouldn't have said that about chicken. Beef, though, the smallest cow herd since 1963, and we killed cows all year last year, even though the economics at the cow-calf level were good. That happens sometimes in the beef industry, but it usually happens when we've got a drought and some part of the country doesn't have any grass. And that didn't happen last year. I think the thing driving this, I think Ron Plain hit it right on the... I've been posing this question. Ron Plain said, it's the economy. And I think he's right, because I think what we're going to see when the farm size data comes out, that this liquidation in the cow herd occurred in small cow herds. It occurred in cow herds that people have as an extra income source or as an addiction, whichever it might be. And with the economy like it is, either they needed the money from the cows or they didn't have enough money to keep subsidizing them. Okay? And I think we're going to see small cow herds were mainly the biggest part of this liquidation. The big cow herd operators that I know of, they didn't cut back any last year. Okay, I think this was an economy-driven liquidation in the cow herd, but it's still going to mean fewer calves going down the road, and we've already had the smallest 2 calf crops since 1950. We're going to have a smaller calf crop in 2011. If you look at the supply of feeder cattle in July, they were down 2.6%, I believe. And if you look at heifers retained for replacements last year, down 2.2%. So this is an amazingly shrinking beef sector that's going to really push prices eventually. Now, you say, well then why did we have so much beef production in the fourth quarter? Demand was good. I think we've really dipped into the supply of market-ready cattle out there. I think we're going to see a lot of green cattle start to come to market as we go through the first and second quarter, and lighter cattle, and we're going to see beef prices go up. Here's the weighted average cutout value. You're always working behind here because you don't have the grading percentages, but up about $25 or 18% for the fourth quarter and still going up. We look at choice cutout. We're very close to the top side of this channel, and it won't take much to get outside of that. I don't know if we're going to take out these 2 or 3 observations back in 03 that were driven by the Canadian BSE situation. But other than those, I don't think there's any question we're going to break the records we've seen, and we may actually challenge those at some time this year. On the chicken side, a real change in the last 6 to 8 weeks. I mean, this was one they were growing. Look at these egg sets. These were 6 and 7 and some weeks 10% higher than a year ago here in October. Here's placements. Of course, they run lag, but they were much higher as well. But look right at the end of the year. It was kind of... Somebody in the chicken companies woke up and said, geez, corn is really expensive. Okay? And they also said, geez, market share might not be the best metric for success here. For a long time, the chicken industry operated, and it's a reasonable operation goal. In a growing market, you want to gain market share. Okay? Full speed ahead. Well, that market has not grown very much in the last 4 years. And so they finally kind of got back and said, maybe it's better to look at profits. And I was real concerned in this scenario, though, with Tyson coming off a very good year across the board and generating a lot of income in cattle margins and beef margins, and having a lot of cash, and JBS having all the cash of the country of Brazil behind them, that's a little bit of an exaggeration, but maybe not much, that they could get into this and get into a huge shooting match and just keep chicken prices low. and really be hard to overcome in the marketplace. It doesn't look like they're going to do that, because they've certainly pulled back a bit on that. And here's their operating margins. See, their operating margins went negative. So they're not really going after the market share thing. They're saying we've got to look at margins, and that's really encouraging. That adds a note of rationality that I think we need. So, competition. Beef, current higher output and higher values. And I think those quantities are going to go down as we go through the year, and we're going to see significantly higher prices that should support pork and hog demand. Chicken, current higher output and higher values. They've kind of got their returns back down to zero, and they've slowed down. They're down. Egg sets placements are running 1% and 2% ahead of last year instead of 4% and 5% and 6%. We can probably live with that. Production may not drive prices lower this year. A very encouraging development, in my opinion, for pork as we go through next year. So, with that groundwork, let's talk about hogs. Key issues, obviously feed costs. Back in June, or I guess it probably was July, when I first started running 2011 estimates based on the futures, there's $20, $25 a head profit in those. That's been as low as -3 in the last month and a half. It was +5 this week, mainly because of the big rally in lean hog futures. Hog numbers, the December Hogs and Pigs report says that we're going to have numbers this year very much like we did last year in total. Now, the movement of those is kind of hard to guess, because if you look at the historical data for the last 2 years, you had to try to figure out what the corn quality had influence was there. And so you can't just take last year and go year-over-year percentage change and ride along with that. Expansion, the breeding herd was 8,000 head larger in December 1 than it was in September 1. A bit of a surprise maybe, but both sow slaughter and gilt retention were higher. So I think what we had on the sow slaughter was the poor end of the cost distribution in the pork industry was looking at $5 and $6 corn and saying, we can't handle that. And their bankers were looking at them and saying, you can't handle that, and we're not going to help you handle it. And they were where the sow slaughter came from. At the same time, the good end of the cost distribution was looking at empty sow barns and putting gilts back in them. So I think we saw that happening concurrently during the fourth quarter, and the offset was here. We still ended up growing the sow herd a little bit. I think that's going to continue here for a while. Demand, domestic, soft, late 09, early 10, but very improving. Exports, good based on value, and I think they're going to be excellent come this year. We look at this measure of wealth, accumulated profits back since 91, $800 down to about $150. We've recovered to $307 as of December, but notice we've gone down. Here's where those June forecasts would have put you. You could have locked in for all of next year and got back up to almost $600 on this thing. Right now you can get as high as $400 based on futures yesterday. The December Hogs and Pigs report, about as expected. No big surprises here except for the farrowing intentions. Now, I don't know if those farrowing intentions are understated or if the breeding herd is overstated. But they don't fit together. The more likely one, in my opinion, is maybe the breeding herd was a little bit overestimated. So we'll have to see how that comes out. But I can't hardly believe if we got a breeding herd that's down 1.2% that we're going to get 2.3% fewer litters out of it come the second quarter. I don't think that's going to happen. So I think this is a little bullish, really, for the deferreds, but I'll be real surprised if we actually have a pig crop that low. We return to 2% growth after 2 quarters of just less than 2%. We're back to 2% on litter size growth. I keep talking to people, and that's still going. Now, everybody always says, yeah, but what about PRRS? And I say, well, yeah, but what about PRRS? I understand that individually PRRS is devastating. But every time we come up with this so-called worst PRRS ever in the history of mankind, it never shows up in the data because A, it wasn't that much worse than last year, and B, the timing was about the same, and so it doesn't come up. So unless it's an unusual one, I always discount PRRS, and I don't mean to be cold-hearted on that at all, because I know if you're out there carrying dead pigs out or euthanizing pigs, it's a horrible thing. But it probably won't show up in the data. I'll be really surprised. It won't show up in the data. I'd be guessing this. It won't show up near as much in the data as this corn quality thing has the last year. Okay, I've never seen PRRS show up that way. Okay, So, back in October, here was the forecast for the fourth quarter. Okay? This was predicted 2010. Look where we actually ran. We were well above that going into the fall, and Mark, I think it's strictly the fact that this corn tasted a lot better and had a lot more nutrients in than it did a year ago. We really ran ahead, and of course, here's where we are coming out of the December Hogs and Pigs report. Again, the red is the prediction just based off of the numbers. Now, when I went back and looked at like 6 years worth of weekly data to try to remove those feed quality factors, we'll be a little lower here as we go through February, and a little higher here. But once we get into new crop corn, we're going to be a bit lower. That's this purple line that I usually don't have in there, but I got to adjust for the impacts that feed quality has had over the last couple of years. And of course, the big one has been weights. And we had hogs 209 pounds plus 2 weeks ago, dropped just a little bit, but we moved hogs about as fast as we could move them this fall. We were very close to slaughter capacity. We're still pretty much there trying to move a lot of hogs through the system. We're not being able to dip into that distribution very far. The question, and I posed this when it went up last fall, was what will stop weights from being higher until we get to hot weather in June? The corn quality is going to be the same. We may be able to run a few more hogs through if demand gets pretty strong, and the packers will take a few more out of the supply than's coming into the supply. But as I pointed out at some places the other way, you want to drop this by 2 pounds, you have to make tomorrow's slaughter disappear and start working on the pigs that you would have done on Saturday or Monday. Okay? And you can't do that very well when you're operating right at capacity. Pork production for last year was down 2.3%, but was up sharply in the fourth quarter, and that's one of the reasons we had so much pressure on prices. We've had about the same this year, dropping back down last week to about 440 million pounds. If we look at the cutout value, of course, it stayed firm in November and December. A pretty normal seasonal pattern there. A big sell-off here as we had lots more hogs and lots heavier hogs coming to market. I think packers were in a very good buying position here for all of the fourth quarter, but they pushed the cutout value above $80 last week. If we look at the price paid for hogs, we had a kind of a counter-seasonal rally late in the quarter. We're pushing that back up. I think this price could be above break-evens once we get to March. So I don't see a lot more red ink here as we go through the next few weeks. Very good packer margins last year, probably some of the best ever, and certainly the best year ever for pork packers. It was a very good year. The margin started out at about 30, and this is gross margin. This isn't the amount they put in their pocket. From this amount, this is selling the carcass, selling the byproducts, buying the pig. So you've got to pay all your fuel, all your labor, all your transportation, all your packaging, everything, all your building costs and everything. There's still very good net margins behind these. Don't get me wrong, but just don't think that they ended up with $30 still. So I measure this because I've got the data to measure it, and it's the one that can tend to tell us how they're going to behave in the market the next week. With good margins, they'll be pretty aggressive in the market. With poor margins, they'll be pretty slow. They're kind of redefining that, but obviously well above the 5-year average. Sow slaughter was higher in the fourth quarter than it had been at any point during the year, and closer to year-ago levels during that fourth quarter, but it was still down about 8.5% for the year. Now, that's on a sow herd that's down anywhere from 2 to 4% from a year ago. So we were still being pretty aggressive selling sows into this thing as we went through last year, and didn't start increasing the sow herd any really until the fourth quarter. I don't think we're going to see a lot of growth in sow slaughter this year. We will be lower than this level because we got a smaller sow herd than we used to. We run a short 1% of the sow herd that's slaughtered every week, and that's going to be pretty close to where we are given these profit outlooks. If we put all that together, and here's the futures, what the futures said yesterday as far as cost of production, the red line is the same one you saw a while ago. This is projected Iowa, Minnesota prices using historical basis levels, and $5.20 per head. February 2010 is going to come up just a little over $10 a head profit for producers based on the Iowa cost and return series. Forecast for supplies, mine are on the right here on a quarterly basis. A little larger supplies in the first quarter, getting smaller as we go through the fourth. Pretty consistent across. If you look annually, Livestock Marketing Information Center says we're going to be down about 1%. Mizzou, 0.5%. Iowa State, 0.4%. I've got just 0.1% for yearly supplies, $110 million on commercial slaughter and change, just a little bit lower than last year. If we look at price forecasts, I've got hogs up in the 80s, bumping 90 on average for the quarter. That would have some $90 hogs in it to get an average that high. But none of us really, Iowa State reasonably close, but we're still all well short of where these futures markets are. And if you got June hogs at 97, how many of you in here have sold a June hog for 97 before? Okay. Yeah, that's how many I thought it probably. I didn't think it'd be very many. We traded June 2009 and June 2008 for $100 for what, 2 days, 3? I think we could accidentally get to 100 on some of these. Now, I will point out that chart doesn't show me that it's topping a whole lot, does it, Mr. Bauer? No. I think I'd have it tell me that first. Historically, summer lean hogs have. I always really get antsy on this anymore. Historically, they peaked out the first half of May. All right? And that's what I said 2 years ago. And H1N1 came along the last week in April and kind of screwed that plan up a little bit. But still, you've got prices at levels clearly in the black, even if you're not doing a very good job buying corn. And I think it's one of those things that this is another year to play defense. Given where your costs are and how much capital you have to tie up in one of these pigs to get them to market, I'd be making sure that I get some profits on those. But I still would watch the technicals on this and make that chart tell me it's making a top before I pull the trigger on selling summer hogs. I told a guy here the other day, and he said, "Well, I sold those Junes at 92." He said, "I sold 20% of them." And I said, "Well," and he said, "But, I can sell another 20% and actually average up, and it's my experience, it's always a lot more fun to average up than average down." So I told him I guess that'd be about right. So.